As a citizen of the country, I feel proud. I think close to 1 billion voters, large number of them exercise that franchise, the biggest show on planet Earth. There is no show that comes anywhere close to this. We've got a stable government. I think this is the third time a prime minister is going to lead the country. And after 1962, we've also forgotten that between 1989 and 2014, we had coalition government. And in this period, Sensex went up from 750 to 25,000 in coalition governments.
The Indians are finally owning India's growth, right?
And we have got now $35 billion of money coming into capital markets, mutual fund SIP, NPS, insurance, all of that put together, EPFO, so on and so forth. That will become maybe $40 and $50 billion. Foreign portfolio investors used to move market with, let's say, $5 or $10 billion. So their influence is going to be lower over a period of time. The biggest assets that investors have actually is not the starting amount of money that they are putting, it's the time that they put.
On this episode of the Create Wealth podcast, I have one of India's most powerful men in the investing ecosystem. I'm hosting Navneet Munot, who is CEO and Managing Director of HDFC Asset Management and also happens to be Chairman of the Association of Mutual Funds of India, or AMFI. In this episode, Navneet talks to me about how markets are poised post-elections 2024, how India's affluent are investing, and the story of wealth creation through mutual funds. I'm sure you'll enjoy this one. I'm Sandeep Jethwani, the host of the Create Wealth podcast and co-founder of Deserve. Navneet, we are recording this 2 days after election results in June 2024, and we are 2 days away from swearing in a new government. A lot of things seem to have happened in the matter of the last 48 hours, right? If somebody had told us, like we were discussing before this, that we will have a coalition government, that the parties will, like external regional parties, will have to play a big role in government formation, we would have had a very different assumption on where markets would be. And yet, probably markets are where they are, slightly above where they were on 31st of May. Yeah. What is actually happening?
So even if you had a crystal ball, as you rightly said at the beginning of the year, that we would have a coalition government and some of the other news flow like US wouldn't have any rate cut, India won't have any rate cut, etc. One would have said that Nifty would be down like maybe 5-10%, small and mid caps would be down even more because they had done better, but market is up, right?
Yeah.
I think, I don't know whether I should say this, but markets normally get two things wrong about politics. Number one, which way the result would be. Number two, once the results are known by evening or next day morning, what will happen to the economy and markets in next few years? And I'll just give you 2 or 3 examples. In 2004, markets rose because the expectation was that NDA is coming back with a bigger majority, and then they opened circuit down because the results were different.
Yeah.
The next 3 or 4 years, markets did phenomenally well, right? Yeah. In 2009, it was other way around. UPA came back with a bigger majority, market cheered it. But then the UPA second regime didn't deliver returns for the investors as much as what was expected in the later part of the regime particularly. So I think we shouldn't pay too much of attention to it. I think as a citizen of the country, I feel proud. I think close to 1 billion voters, large number of them exercise that franchise, the biggest show on planet Earth. There is no show that comes anywhere close to this. We've got a stable government. I think this is the third time a prime minister is going to lead the country. And after 1962, we've also forgotten that between 1989 and 2014, we had coalition government. And in this period, Sensex went up from 750 to 25,000 in coalition governments. And now in fact, the number of seats that BJP has is much higher than any largest party had between 1989 and 2014. Yes. So in last 10 years, we got used to a single party majority, but maybe I think even with the number of seats which are there. And another thing we need to keep in mind that in India, there's by and large a consensus among all political parties that we need to grow at higher rate.
Correct.
There could be few optics here and there, but there is, I think, a consensus on growth and there is consensus on importance of structural reforms. When you sit in opposition, you will make a noise, but when you are in treasury bench, you will do exactly what the other person would have done.
Correct.
So I feel optimistic.
And there's natural anchoring bias. Like everyone was expecting a different verdict, and therefore. But what happened in the 24, 48 hours? Markets went up and down. How were investors reacting? What were mutual fund investors doing?
You'll be surprised to know this. I'm not surprised. So on the day of day before, when markets fell like 6-7%, big fall,
when the results
the
started.
number of purchase transaction and the amount of purchase, both in terms of number of transactions and the amount, it was a record amount for us relative to what was happening in several days before. So investors wanted to take advantage of that drop, and this is a big shift in the psyche of Indian investors that we have been noticing for last couple of years.
And this theme seems to be continuing. FIIs are exiting, and domestic investors are much more filling up for the gap. They're overcompensating. What is happening? Is the argument to be made that FIIs are valuation focused and Indian investors are not? Or FIIs are looking at India from a relative perspective compared to other markets, and Indian investors have to invest in Indian equities?
See, again, FI is not like you cannot put all of them in one basket. There are long only who've been structural investors in India for a very long time. There are some of the hedge funds and some of the other investors who might be looking at relative valuations from a shorter term perspective. There are different kinds of investors. By and large, what's likely to happen over the next several years is that while in absolute amount, FPI money in India will be higher and higher and higher. And I can discuss that, why I feel more positive on that. But on a relative basis, in terms of the ownership of the market, domestic investors would become bigger, right? I mean, we have got now $30-35 billion of money coming into capital markets, mutual fund, SIP, NPS, insurance, all of that put together. EPFO, so on and so forth. That will become maybe $40 and $50 billion. Foreign portfolio investors used to move market with, let's say, $5 or $10 billion. So their influence is going to be lower over a period of time. But I'm very optimistic on foreign portfolio investors putting more money into India over the next 5-10 years.
But it's such a proud situation that Indians are finally owning India's growth, right? Because a large part of the growth outside of what promoters own was earlier FPI or FII holdings, right? And now that proportion has gone down quite significantly.
So at the peak, they own 25% of market, which means 50% of free float. Because if you take by and large 50% with promoters, or like almost half the free float.
So we were exporting our growth, right?
Absolutely. The returns of our growth were getting exported. You are absolutely right. And it's good to see that Indians are now taking greater ownership of our own businesses.
I mean, we've been speaking about how domestic investors are putting money in India. One of the biggest powers about India is the fact that we have such a large diaspora, which is wanting to put money into India. You interact with so many NRIs. What is actually happening there? Are they actually deploying money into India?
My sense is that historically, while they had a pride on India as like being an Indian, but I don't think they had as much faith on the growth potential and what the market can deliver. I think they all have been under-allocated to India as an asset class. They are over-allocated somewhere else. And now they have seen that India is doing so well. India is making all the right kinds of, I would say, news flow everywhere in the world. And they feel that they need to have much greater allocation to India. I think whether from a regulation perspective, from an ease of investing, ease of transacting, etc., if we do a little bit of more work as a country, I think flood of money likely to come from our own, the NRIs and the diaspora.
One thing that a lot of people don't know is the double tax treaty benefits that a lot of countries offer when it comes to Indian mutual funds, especially UAE and some cases Singapore also. If you're a local tax resident, it's very tax efficient for you to invest in mutual funds in India. But as this is growing, Navneet, there's a lot of noise and talk about long-term capital gains tax. From what you know, what is actually happening there?
My view is that what India needs to do in the next 20-25 years is to ensure that we get greater and greater participation of large part of the population in capital markets. Given the public debt to GDP, the starting point, 81% to GDP is public debt. While we can give a free toilet, it's a great thing that has happened, a free toilet, maybe to 800 million people, wheat and rice, whatever, Ayushman Bharat and a free, whatever, a basic bank account and many of the things, tap water and all of that. But I don't think government of India would ever have money to secure retirement of all the people. I mean, even the affluents are under risk given the lifestyle inflation and longevity of life. And what the government's agenda has to be that we get greater participation of risk assets in population to ensure that growth reaches everyone. Otherwise, we will become a rich country from the size of the economy perspective, but from per capita and the retirement won't be secure. So I hope that becomes a larger objective than maybe what revenue can get in next few years.
This part is very interesting. When you spoke about the fact that life expectancy is increasing and inflation is a reality.
Lifestyle inflation. See, the good thing that has happened in India, we have moved away from that. Every few years we used to have this bout of 10-12% inflation. The growth used to get stalled because RBI would tighten, so on and so forth. Now that with the monetary policy framework, RBI would kind of like try to anchor the inflation at around 4%. But the lifestyle inflation is very different. We were not consuming the things that we consume today. We were not experiencing things that we want to experience today by spending money. Healthcare, education, leisure, everywhere. I mean, the amount of money we spend on gadgets every year wasn't the money that we were spending earlier, right?
Correct.
So for that, you need a much more money in market today, and you're going to need that for much longer.
So as investors, everyone should increase exposure to risk assets or equities in general and equity mutual funds in some sense.
I tell the richest of the people who says that, I have this much of money. I said, you're much smaller than what you should be having as part of, let's say, the wealth that you already have and what you aspire to have for your lifestyle and other things. People should invest more.
I'll come back to this, Navneet, but the other flip side of this risk taking is what we are seeing in the futures and options market. India has become the largest options market in the world. There are close to, at last count when I was looking FY22, there were 50 odd lakh options and futures investors in India, and the average trader is losing 1.1 lakh, which means that if you just do the math, it's about 55,000 crores of wealth destruction that has potentially happened in just over a year. What's going on? What can be done?
It's a wealth creation of some offshore hedge funds and few other guys.
Explain
I
that
look at it
also.
in two manners. One is that, of course, India and F&O capital of the world, large number of people are losing money as per SEBI studies, so on and so forth. I look at it from two perspectives. From a society perspective, what I see is that people want to become rich. People want to make money. There's an aspiration to become wealthy, which is good change in society. And they want to take risks. They have more faith on the country, on its economy, on its market. Now, I mean, ultimately you have to get nirvana, but at least you want to get nirvana, which is like, I want to create wealth. Now, they are looking at various ways. You talked about the F&O. We've got 200 million people, 20 crore plus people KYC done on gaming apps. Or playing few hundred, few thousand, few lakh rupees on IPL or other things.
We don't even know how much money is lost there.
And I think I've heard, not that number I have, but there are millions of people on crypto apps. People want to make money, which is a good change in society. But the other way is, my belief is very strong belief. There is only one formula of creating wealth in the long run. There is only one formula of creating wealth in the long run. And that formula, so that people remember, is STP. What is STP? Not a systematic transfer plan that you know. Of course, there's a process. It's sound investment plus time plus patience. If you take any one of these, you won't create wealth in the long run. When it's sound investment, and you need Sandeep for that to advise you, you need time and they need you so that you can hold them, and you need patience. If you lose patience because from whatever government that we were expecting its coalition, you do something in the market, you won't create wealth.
What can wealth managers do to help people with this thought process? Because time and patience are hard to communicate, right? That And oftentimes you're telling people that don't do anything, just stay invested. So what do you think the best wealth managers have done to solve for this?
I think it's that part, the T and P part. Sound investment, of course. I mean, you need the research or whatever you need to know. But in the long run, wealth creation doesn't depend on how much you know. It's all about how you behave.
Sure.
Not coming under the influence of media. And in today's world, when I think you are constantly on your phone with your Twitter and whatever, all the social media and WhatsApp, it's not very good in the long run for your wealth creation, because it gives you an illusion of control. It gives you an illusion of knowledge that you know so much. But data is not information. Information is not knowledge. Knowledge is not understanding. Understanding is not wisdom. Where the wealth manager can help you is harness the power of your wisdom. And particularly that, it's kind of like staying put or just staying calm when others are losing their their sanity. That's the biggest role of the wealth manager. This is my view. Also, I think this awareness about some of the larger things like longevity, what you discussed. I'm so happy that you mentioned about it. When India got its independence, I think our average life expectancy was 37 or something. Today, it would be almost double of that. Seriously. In our lifetime, it will cross 100. The way, in fact, in my annual letter, Person of the Year, I mentioned that new age of health tech was my Person of the Year last year. I see that like transformational things, paradigm shift in next several years. With that, people need to prepare for a much longer time frame. I'm sure you meet investors, they say, I'm a long-term guy. I look at 5-10 years. They look at 50-100 years.
And the other thing is that social structures are also changing, right?
Absolutely.
Like there was a time when everyone could depend on their family, and I wish that the Indian family construct still stays. But the reality is that people will have to fend for themselves in some cases, right? And their children may not have the money or the wherewithal to be able to support them.
Absolutely.
And that's very real and coming up. So therefore, having a strong, sound investment profile, being patient about it and giving it time. I think is very important.
The biggest assets that investors have actually is not the starting amount of money that they are putting. It's the time that they put. That's a bigger asset. But you can only leverage the power of time if you have patience. And for that, you need someone to do the handholding.
Navneet, when I started my career in the early 2000s, this concept of SIP didn't exist, right? And today we have $3 billion of money flowing into Indian markets on a monthly basis. That's like a new wealth management company getting created every month, right? Why has India done this, and how has it come to be? Because you've observed mutual funds from up close.
So the SIP, actually at HDFC AMC, we led it from the front. Couple of other AMCs have done that. Industry has done a phenomenal job in terms of promoting the concept of SIP. But for a long time, I think our total amount was very small. Till 2016 or 17, we were like 40 billion rupees a year, 4,000 crores a year. In the next 3 years, it was 8 and then 16, and now we crossed 20,000.
Now we do 4,000 crores in a month,
this is just beginning. There are 4 reasons for it. Number 1 is the track record. You got funds like HDFC FlexiCap Fund at 10,000 rupee per month SIP over 29-year period is 17 crore rupees. 10,000 rupee per month is 17 crore rupees. I meet people, they say, I always had मतलब 10,000 रुपए महीना तो मैं लगा सकता था, मेरे को नहीं पता था एक statement will be 17 crores of that. And if you put like 100,000, it will be 170 crores. Again, I have to say past performance is no indicator of future performance. Maybe rates were higher, inflation was higher, it's a different environment. But it shows the power of compounding, number 1. The second is the transparency. This is the most transparent product in the world, one of the most transparent product in the world, mutual fund. Third is the technology, making it easier and easier. You guys have worked so much on that. And fourth is the training. I mean, just to create an acronym, 4T. That is the investor education. This whole about power of compounding, stay put, don't get swayed by the volatility, so on and so forth. This has led to now, finally in last 5-7 years, we are reaping the benefit of all the hard work of 20 years. And I think this is just the beginning.
But have you seen this play out in other markets where this systematic default investing has happened?
This is very interesting, and I always give, there are who said that? Mark Twain, history doesn't repeat, but it rhymes. There are striking parallels between what happened in US from 1980s onwards and what's happening in India over the last couple of years and will happen over the next 20 years. First was the Paul Volcker in 1980 who said that I will break the back of inflationary expectations in US. In 2016, RBI put the monetary policy framework that we will ensure inflation is hovering around 4%, which is a big shift from what we were before. Number two was Ronald Reagan, who said government has no business to be in business. And our prime minister has been saying less government, more governance, and we privatized Air India. We underestimate it. The third is the demographics, India, and the baby boomer generation of US. And the fourth was the 401k movement in US. And India, we are seeing that SIP and how people are kind of now looking at long-term investment. What it did for US was in next 30, 40 years, whether it was equity, whether it were bonds, whether it was high-yielding bonds, muni bonds, private equity, venture capital, real estate trust, infrastructure trust, all the asset classes did phenomenally well, both in terms of the size of the market as well as the asset class returns. I think India is in that the 20, 30, 40 year period. When Fidelity Capital would have been 40, 50 billion dollars, maybe the size of money that we are managing, we manage 75, 70 billion. They are today managing trillions of dollars. BlackRock didn't exist in 1980. It got set up in 88. It's $10 trillion. Blackstone is $1 trillion. So same thing will happen in India.
And what does this mean for the Indian markets? Because all of this money has to find its way into good quality stocks that hopefully fund managers can buy. Are there enough high quality papers? Is there enough supply of good companies that we can invest into?
Of course. I mean, who would have thought some of the large caps today would have been a mid cap yesterday and a small cap day before? My point is that maybe a couple of years back they were mid cap and a couple of years back they were the small caps. How India has grown. We are still at $2,500 per capita GDP. So we have a long way to go. Again, 1980 and today, if you look at the size of the US GDP per capita, etc., you can relate to that. From a $4 trillion economy, as we become 7, 10, 12, 15, the number of businesses, the existing businesses, the scale that they will gain, and large number of businesses are yet to be listed in India. We created a $1 trillion market cap in a matter of 7 or 8 months. The last $1 trillion got added to it. Now that just shows the power of now Indian market and what the primary market would be over the next 10 years. There's so many businesses funded by VC and PE today who are yet to get listed, gain scale, and then come to the secondary market. And I think that will continue. Long way to go. And a lot of global companies will raise money from Indian markets because we would become so big. We are third, fourth largest in terms of number of companies, one of the largest in terms of market size. So a lot of global companies will raise money from India.
It seems like mutual funds are here to stay. They will continue to grow. That there is enough supply of paper. What I find really exciting is the fact that mutual funds are so well regulated relative to any other instrument, right? But there is a perception among, I would say, the wealthy investors that this regulation hurts their return. Now, what is your perspective running a mutual fund, both as earlier fund managers and now as CEO? How much of the regulation is actually impeding returns in mutual funds?
That's not true, because the most important thing is the trust and how that trust gets built because of the transparency, because of the risk management, because of the compliance, because of the governance, because of putting those guardrails, putting those boundaries that actually enhances the longevity or sustainability of those returns. I mean, everybody can be a hero in a bull market. What is that Munger's quote? Don't confuse brains with bull market, something like that. But the longevity and sustainability also comes from the well regulation. We are so scrutinized in public. We are so well audited. We are so well governed. I think it helps investors in the long run. A lot of my friends and everybody says, "Arey yaar, itna regulation, ye tough hai, skin in the game," the kind of everything that we have. And I keep saying that, think from a long-term perspective. This will build more trust. This will ensure that you don't make mistake. Investing is more about avoiding errors of commission, not reducing errors of omission.
You referred to skin in the game, Navneet. a lot of people don't know that professionals working in a mutual fund have actually got to put their money into
all my fund managers, analysts, CIO, myself, all are.
So can you explain what's the regulation there for the benefit of a lot of people?
So 20% of our salary, and there is a whole formula, I mean, after the tax and some of the other statutory deductions, etc., of our salary income, my incentive, everything that I get from the organization, and so is the case with my fund managers, other members of investment team, and couple of other people in the organization. 20% every month gets cut, and for me, it's in the proportion of the size of the fund, weighted average. Every month I contribute to that. For the fund managers, a larger part in their own fund, they invest, and there is a lock-in of 3 years on that. But to be very honest, all of us were already doing it.
Yeah.
But maybe I think now it's an industry-wide.
The interesting part here is that, and mutual funds today are 27% of bank deposits. Mutual fund AUM is currently growing at 18% year on year. The FD AUM is growing at 11% year on year. We were thinking about it in the term of this government, 2029, this number will become 50%, right? So mutual funds as a proportion of deposits will become 50% in India. What do you think are the second order implications of that? What will happen as a result of it?
The largest bank in the world would be, I think ICBC would be around $5 trillion of assets. Largest AMC, BlackRock manages $10 trillion of assets. Largest AMC in the world is double the size of largest bank in the world. And in India, you see the growth of our industry. Last year, industry added around 14 lakh crores of AUM. That is more than the total AUM we had as an industry 10 years back. The total equity AUM in 2014 of the industry was 2 lakh crores. We manage double of that today. HDFC AMC alone. And I think this trend will continue, right? Because the SIP book wasn't as big earlier, which is now, and this is a structural money. As I told you that Fidelity Capital, all of these guys were 30, 40, 50 billion dollars in 1980. They manage trillions of dollars. It will be very similar here. What it does is that our markets used to be very vulnerable to the global flows, global risk appetite. I used to say that we dance to the tune of global liquidity, global risk sentiment. We used to global sentiments, global risk on, risk off, global interest rate cycles, so on and so forth. Now, what this money is doing is providing stability to the market, reducing our vulnerability on the global flow. This also ensures that primary market, there would be like cycles, of course. It's not that every year will be similar, but our primary market will become very robust with this kind of domestic money flowing in every month. I mean, give wings to our entrepreneurs, their ability to raise equity capital from the domestic market. So it will do a lot of good to the country. Also ensuring that growth is inclusive. In a democratic setup, growth is more inclusion. A democratic setup, as more and more people own equity, they will be a partner in the country's growth. And the pressure on the government to do something else to that extent reduces.
Yeah, absolutely. And I think this concept of wealth effect can play out in various ways, right? Talking about wealth, today there are 24 crore households, give or take, in India. About 1% of households have more than $100,000 of investable surplus financial assets, right? So that's about 24 to 25 lakh households. How are the wealthy investing differently relative to, let's say, the retail segment from your vantage point?
I think because of the resources, access to information, and the risk appetite, I think they have like maybe more asset classes where they invest in. So apart from the core fixed income, they look at not only the public equities, but they participate in the private markets, private equity, venture, real estate, the high yield credit, etc. Some of them have international diversification, would have invested in various ways, and of course the real estate and the commodities. So you would see like participation in higher number of asset classes, a greater risk appetite. But the one thing I would say is that when we started our career in the 90s and then in the initial part of 2000, wealthy used to allocate a larger proportion to the mutual funds, and they actually benefited from that. Then there was a period where they thought that this looks like a more retail product. And it's not for me. I mean, even 1,000 rupee per month guy is investing. So
and I need to do something. That's the case today too, by the way.
But it's changing.
Yeah.
We are getting like, the systematic transfer plan where people put like a couple of crores and then put like kind of an STP of every month.
Yeah.
People are understanding that, this dollar cost averaging every month and not try to time it all the time is actually a very good thing. Whether you have 10,000 rupees a month or whether you have 10 million rupees a month to invest, I think the benefit is exactly the same.
Tell me, Navneet, you were telling me before we started recording that there was a time when the wealthy or the seriously rich would mandate exit pollsters to track what is going to happen on result day and preempt that. Today, also, the wealthy have disproportionate access to information. Okay, or they have more access to information. Whether that is translating to investment wisdom, like you said, is debatable. How is some of that coloring their judgment, and is that translating to better returns or worse?
Access to information, whether it helps you, I'm not very sure about that. See, as a fund manager, I always tell our guys, how do we generate alpha? We have information edge, which doesn't mean that we have more information about a company because it's all publicly disclosed. Whatever they tell us, it's there on their website also. But it's about putting more resources, doing the channel checks, understanding it more. We have more resources to kind of meet larger number of companies, larger number of players, larger number of customers, vendors, everybody. We have analytical edge. But these days, like anybody can analyze. There are all kinds of screeners available and you will support that. But the biggest edge that we want to create over a period of time is the behavioral edge. You behave differently than the rest of the market. That makes you, I think that generates alpha over a longer period of time, not the information edge and analytical edge so much. And that's the most important part.
That makes a lot of sense, Navneet. The one thing, as you were talking about this, I was very curious about is what are the systems that go behind running such a large asset management company, right? I'm sure there's a lot of investment happening in technology, people, talent, and other resources. How do you allocate capital at a broad level across all of these big decisions?
So our biggest asset is our people. The biggest asset that we have is our people. And it's not only about the intelligence or the talent or anything. I think it's a culture of the organization. The way people are dedicated to the noble cause. This is one of the most noble job in the world. Managing someone else's money. Every wealth manager I meet, everybody who's in AMC business, I always say this. This is the most noble job in the world. It is as noble as, let's say, when you go to an operation theater, you're putting your body at the and you trust the doctor. It's same. Somebody's trusting you with their money, and you need to have that deep sense of purpose, deep sense of trusteeship. That culture, I think, is the most important. Then you put the right set of processes, you put the right set of risk management. Again, talking about risk management, it should not be an after the fact activity. It has to be ingrained into the investment process, the way you do it. My risk management team sit alongside the investment team, and they work together, but they are absolutely independent. And sorry, go ahead.
So this seems very interesting. What does a risk management team and how does it interplay with the investment team?
How do you build an outstanding investment house? You do four things. Number one, you need to have clarity of mandate. Your investment philosophy, the way you articulated what you'll do, what you won't do, has to be absolutely clear on every mandate. Because you are telling your investor, this is how I manage my money, and you have to be true to the mandate. The number two is you put robust research, which is like the quality of people that you have, the way you do your research, the way you analyze things. The third is the portfolio construction. How do you create that portfolio? The way you size your bets. How do you generate alpha? Either you do market timing, whether you'll focus on that. At our end, we don't do that much. Do you focus more on sector allocation from a top-down perspective, or would you do like bottom-up stock picking? Different. There is no like one holy grail. Different thing. But that portfolio construction approach should be clear. And the last but not the least is the risk management, supervision, governance, our monthly investment committee, our risk management committee of the board, risk management committee of the trustees, and all of that controls that we put in place to ensure that all of these three things we are doing what we are telling our investors we will do, and keep sharpening that.
This therefore needs a critical mass, because this sounds like a costly affair to do.
Of course. And it's not only costly about money, right? People can, you can go and buy talent, but putting that culture, putting that long-term orientation, putting that sense of trusteeship, putting that risk orientation, compliance orientation, easier said than done. And that's why not many asset managers kind of like are able to deliver over a long period of time. And that's a trick.
Navneet, you personally have lived the pretty much every part of the mutual fund journey, right? You were a CIO for a very large asset management company. Now you're CEO of one of the largest asset management companies in India. Why did you decide to switch from being an investor to an executive?
As an asset manager, whatever role you are doing, ultimately you're managing somebody else's money.
Sure.
I may not be like managing money on my own. I used to sit in the dealing room as started my career. I used to be a fund manager. That's how I grew. I still love watching, reading, analyzing macro. I bump into once in a while in evening to our investment team and then have a great exchange of views. But I've always had deep interest in people. And this is about, the role is about having deep interest in people. One is like your own people who work with us, who are part of HDFC AMC family. But our partners, I always had great relationship. Entire my career, even as a fund manager, I used to spend a lot of time with our partners, with our investors, with let's say other, the ecosystem. I've always spent a lot of time with the regulator, would have been part of many things that we would have done in the industry. So maybe the role just kind of got evolved. I've got a new, I would say, stakeholder, which is like our shareholders. And I love serving them. So it's like an amazing job. You have to, if you believe in karma, and I'm like, you have to do a lot of karma for several lives to get this job.
I think karma is coming back because you would
so
ask.
Lucky.
You would ask other CEOs questions of what their company is up to now. Probably you answer those questions. How is it being on the other side of things?
So a lot of my friends, I think, kind of joke that, again, it's karma, that you used to ask us these tough questions. Now you get asked tough questions from your shareholders every quarter or whatever, 6 months, 1 year. They ask you about your growth, your margins, your cost, etc. And I used to ask all the time.
How's your previous experience helping? Is that helps you preempt some of these questions?
Of course. And what we were looking for in an outstanding business. So, and so lucky to be part of HDFC. This building is was a temple to us. Whenever we used to come, we used to salute this building and bow down with a lot of gratitude for the value creation it has done for all stakeholders and the values that I think that we used to look for in any other management or business, that this is what, let's say, an SDFC group does, or maybe the other couple of those marquee groups in India do. I think it just helps us as an investor, what I have kind of done before.
You've spoken about how you look at companies, but what are the values that you look for in a fund manager? When you recruit a fund manager or when you're evaluating a fund manager, what are the 3 or 4 things that to your mind are very important?
I think, of course, intelligence is important. You cannot manage somebody else's money if you don't know how to kind of manage a fund. The integrity is very important, and integrity in the broadest sense. Integrity is doing the right thing when nobody's watching. It's not because regulation asks you to do that. It's not because your offer document. It's not because of your risk management and so on. It's it's in your blood. It's in your DNA. Inquisitiveness, sense of curiosity. But the most important trait is actually humility. Market is a great leveler. And if you don't have the humility, you won't survive in this business for long. So I think a deep sense of trusteeship. This is not about me. This is somebody else's money, and that humility that I may be wrong. The team, I think you have to work with the team. There are very few great solo managers.
No, very, very interesting. You're also now in a position of being chairman of the Association of Mutual Funds of India. That too seems like a massive responsibility because, in a sense, guiding policy and execution around it. What are some of the big priorities that AMFI has right now?
So first of all, I mean, it's an association and all the volunteers, I think all the other CEOs, our CIOs, our compliance officer, risk officer, CTOs, everybody works so hard. I mean, all the committees in the AMFI work so hard to ensure that industry becomes more transparent, industry continues to remain investor friendly, and we make it more investor friendly. How do we keep increasing the standards and the the way we operate? We work very closely with SEBI, and SEBI always says that we believe in co-creation. We work together. So I think the priorities are, how do we grow a lot more. All said and done, we talked about all the numbers, that industry was 1 lakh crore in 2002. It is 57 lakh crores today. But all said and done, there are only 45 million investors in mutual funds in India, unique PAN level. This number has to go up very, very substantially. There are many. So equity as an asset class has done well, but fixed income hasn't grown so much in last 5-7 years. I was like a bond fund manager, and I've seen growth in certain periods. We have a long way to go, and in some of the other product classes. How do we ensure that we take pride that this is one of the most transparent product in the world? As an investor, you could have so much of faith in terms of the information that you get about us, but we never get complacent on that, on any part. We continue to enhance the standards, be it the technology, be in our disclosures, be the way we operate on all of those things. So many things are going on in the industry. A lot of things come in public domain because, as I said, the SEBI does all the co-creation. But priority is that we keep building the trust in the industry. And industry is consisting of phenomenal people.
No, seems like mutual funds are in good hands.
सही है.
Mutual funds सही भी है.
और सबके लिए सही है. I think again, just going back to that point, somebody thinks that, I mean, I don't need this product which is for 1,000 rupees per month. It is a good product even if you have like 1,000 crores to invest.
That's an important point, right, Navneet? Because opportunity is in plain sight sometimes. And there's a belief that sometimes a lot of opportunities are hidden. They're not. The mutual funds are easily accessible. You can get in and get out all points of time, full disclosure. So I think it's a fantastic place to be in. For me personally, I was just getting off my car and I looked up at this HDFC building, walking in. I think it was an emotional moment because this is a building that we've all revered all our lives. So fantastic to meet you here, Navneet, and also thanks for hosting us in this office.
My pleasure.
It's been great chatting with you.
Thank you.